Good morning from New York. I'm Annmarie Horden. This is Daybreak Europe, 6 a.m. in the city of London. Here's what you need to know. Stocks push higher amid falling U.S. jobless claims and a weak tips auction, suggesting confidence in the Fed's view on inflation. European finance ministers meet in Lisbon in person. This as EU negotiators back vaccine passports in a bid to save the summer. And Israel and Hamas agreed to a ceasefire ending a deadly 11-day conflict. President Biden praises the accord brokered by Egypt. Very good morning to you. A happy Good Friday morning. For the most part, good news is dominating the market direction today. At the end of a very busy week, the economic recovery narrative, that is what is winning over this morning over inflation fears as U.S. jobless claims yesterday came in better than what was expected. So let's see where we trade this Friday morning. MSCI Asia Pacific, the regional benchmark there, we're up 0.2%. A little bit of a pullback, though, when you look at what's going on in Hong Kong and China this morning. Partly that could be due to what's going on in Tencent. NASDAQ futures this morning up 0.2%. Tech making a bit of a comeback yesterday, rallied past its 50-day moving average on the close. 10-year Treasury yield 1.62%. As I mentioned, that TIPS auction, the 10-year inflation-protected Treasuries. That auction was met with weaker demand, but what that suggests is confidence building in the Fed's narrative on inflation, that this potentially is going to be temporary. And then Bitcoin, we're back above $40,000 per Bitcoin, a volatile week to say the least. But right now where we're ending up is about $8,000 short of where we were, say, a week ago. Definitely not one for the faint of heart. You have to have a pretty tough stomach, I think, for this week if you're in the crypto space. Joining us now on this Friday morning to break down a lot of this data and what's going on in the markets is Peter Shafrick, RBC Capital Markets Global Macro Strategist. Peter, thanks so much for joining us this morning. I just want to get a take on what's going on this particular morning with the markets. It does seem like the narrative seems to be back onto the economic recovery, given the better jobless numbers. What do you make of this?
Well, look, I think over the last 6 weeks or so, we have particularly driven out of the U.S. A slight change in tone. Obviously, nominal yields have been going sideways, but underneath the bonnet, you saw that still inflation expectations were going up, real yields were coming down. And I think just what you suggested happened in our view, that the market took the view, well, maybe everything is not as strong as we expected beforehand, but in the meantime, the inflation narrative is still there. Now, as you suggested, I think over the last 2 days or so, and I think that might be the case today, we have a slight sort of change around again, where the expectations for economic activity is improving slightly. In the meantime, inflation expectations are pulling back. You mentioned the TIPS auction earlier. Oil is coming down again. So all of these things, I think, sort of give us a bit of a mix of a slightly better sense in the market. And you see that in the risky assets as well.
What camp are you in, Peter, when it comes to inflation? Are you on the Fed side that this is something temporary and fleeting, or do you think that we could have price pressures for a bit longer?
Well, to be honest, I think there's an element of truth in both of these sides, because when you look at what the Fed and, in fact, most of the central banks are looking in the here and now, at the supply disruptions and the base effects that come from particularly oil, but also other energy markets. I mean, some of that element is going to be temporary. There's absolutely no doubt about it. But then the question is, how are the inflation pressures is too strong a word, but how the inflation dynamics unfolding thereafter, particularly in an environment where interest rates are still relatively low, where public spending is relatively high, where we have initiatives about new industries such as the green revolution and all these type of things. And I think there is an element here where we can say that maybe these strong disinflationary pressures that we had before, they have come to an end and they give way to something different. So it doesn't mean that we have to go back straight into what we came from before the pandemic broke out.
Where do you see commodities going? I'm really taken this week what's going on in China in the sense that they're putting pressure on the fact that they want to try to halt some of this rise, especially when you look at the likes of what's going on in iron ore specifically.
Well, I mean, one of the things in China that's very interesting at the moment is that they seem to have changed their policy again slightly, and going back to what we had already a couple of years ago, where they're trying to rein in on excessive leverage, where they're trying to rein in on some of the high debt level, particularly in the corporate sector, and that is probably going to weakened demand to some degree for some of these raw products that you just mentioned. And one of the things that we have to see is, A, how excessive is that policy push going to be? And secondly, what are the ripple effects, particularly for us here in Europe, because we know we have strong connections into Asia in general and China specifically.
All right, I want to get back to the Treasury market. The 10-year has been totally range-bound. But your notes, you're talking about still quite bearish, and you think higher yields is the path forward. When you look at the 10-year, what do you see in terms of the year-end target?
Well, look, I mean, for starters, before we go to the year end, for starters, I think the critical hurdle for markets is the recent top at 175. We're about 10, 12 basis points away from that. We think there's a very decent chance that we can overcome that because, look, the next debate, and we've already had that sort of a little bit of a taster in the Fed minutes when they came out, going into H2, the debate about what the Fed is going to do with their purchase program is going to happen. It's going to come. And then the question is which debate is going to come thereafter. And we reckon that the next debate then will be shifting to the front of the curve when our rates are going to move. And irrespective of what the Fed eventually is going to do, in a recovering economy, the market is going to push that narrative. So I think, for the time being, we could easily overcome that 175 level and probably approach 2% as we get closer to the end of the year.
What's the timeline you have in terms of the Fed starting to talking about tapering?
And again, it's very difficult to sort of nail that down on an exact day. And to be honest, I mean, obviously it is important on the day, but if you take a strategic view, somewhere over the next 3 to 4, 5 months, it's almost certainly going to come, that debate. In fact, it's already here when you take a look at sort of what the market is saying. Some members of the Fed have already mentioned it. So in my mind, it's almost inevitable.
I just want to close out in terms of what's going, Peter, on this week specifically. A very volatile week, especially in the crypto space. Do you see any underlying shift? Well,
I mean, not necessarily, because I think in the crypto space in particular, as far as I'm aware, there have been a lot of leveraged positions that probably have been cleared out. I mean, you got to keep in mind, it's not the same kind of regulation in that market as in, let's say, most of the markets that we generally look at. So I think it's easier to sort of create these significant swings that we've seen, both to the upside and the downside, of course. One of the things that we've seen is there is a feedback effect into the other asset classes, but it has been relatively moderate. So if the same kind of slide happened in another market where more players are active, or where more institutional investors are present, I think the ripple effects would have been greater.
All right, Peter, thanks so much for joining us, and you're going to be sticking around. Peter Shafrick, RBC Capital Markets Global Macro Strategist, stays with us this Friday morning. Let's get a recap, though. Your first word news with Annabelle Drewlers in Hong Kong. Hi, Annabelle.
Annmarie. The number of UK cases of the coronavirus variant from India has more than doubled for a second week. Health officials are also monitoring a new mutation of the virus. It's adding fresh doubt to plans to fully unlock the economy from next month. Still, the government is increasingly optimistic about the effectiveness of vaccines. More than 70% of UK adults have now had at least one dose. China has defended retaliatory sanctions on the European Union. That's after the bloc's lawmakers voted to freeze an investment deal agreed late last year. The European Parliament cited the restrictions as the reason for the move, calling them baseless and arbitrary. Lawmakers say no talks on ratifying the deal will be held while sanctions are in place. Morgan Stanley's chief executive has unveiled his biggest leadership change in over a decade, with a slate of potential successors that mostly resemble the old guard. Just days after JP Morgan pushed two women toward the front of the field to succeed Jamie Dimon. Morgan Stanley's top picks are all white and male. The bank says it's committed to developing and promoting diverse talent at all levels. The US Treasury wants transfers of at least $10,000 of cryptocurrency to be reported to the Internal Revenue Service. Cash transactions over $10,000 are already subject to the rules. The White House is also calling on banks to help boost tax compliance. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Annmarie?
Annabelle, thanks so much. Annabelle Jewelers in Hong Kong. Just ahead, Europe's road to recovery. EU finance ministers meet today in person. Haven't heard that in a while as optimism about the bloc's economic rebound grows. We're going to be live in Lisbon next. This is Bloomberg.
We don't want to declare victory prematurely, but if we can get the 70% of adults vaccinated with at least one dose by the 4th of July, the way the president has set the goal, I think the chances of there being a surge or a rebound is extremely low. That's the reason why we want to continue to get people vaccinated.
Dr. Anthony Fauci, director of the National Institute of Allergy and Infectious Diseases there, speaking to Bloomberg yesterday. Now, European finance ministers are gathering in Lisbon for the first in-person meeting since September. This is as optimism about the recovery has seen European stocks jump at the most in 2 weeks. Our reporter Maria Tadeo joins us from Lisbon. Maria, great work to be on the ground. Finance ministers, they're starting to assess this recovery. What's the mood? And then also, what about these vaccine certificates? Is that going to be something that happens?
Yes, Annmarie, and you make a good point because finance ministers are meeting here in person for the first time since September. And that, in a way, really encapsulates the story here, which is Europe reopening, the vaccination accelerating, and perhaps growth also accelerating in the European Union. And Annmarie, yesterday I spoke to the Portuguese finance minister, João Leão, and also the head of the Eurogroup, Pascal Donahue, and they told me, we do see growth revisions coming and a recovery that is now taking shape. Let's take a look.
We are becoming very optimistic. We went from a very strict lockdown in the winter, very tough, intense, but now the vaccination program is working very well. The number of cases is extremely low. We're opening up already most of our economy, and the numbers remain very low. And now the tourism is back.
I believe the optimism about the prospects for the euro area are justified.
We are expecting that we can revise upward our GDP up to close to 5%. We were at 4% before, and now we're expecting much higher GDP growth.
We should be optimistic about our prospects for the second half of 2021, leading into a strong start for 2022. And therefore, I do believe it is possible that we will see further revisions in our growth expectations as we move through the year.
And that was the Portuguese Finance Minister, João Leão, the head of the Eurogroup, Annmarie, Pascal Donahue, both saying we are expecting a much faster recovery. Now, in the case of the Portuguese, as you heard, they're now expecting a 1 percentage point increase to their forecast for 2021. And Annmarie, to some extent, that is also feeding into markets. You saw yesterday European stocks jumping the most in 2 weeks, again, on that optimism that Europe is vaccinating quicker and the economy is reopening.
Yeah, Portugal definitely looking to possibly raise those forecasts as tourists begin to return. Maria, I just want to get a little bit more insight on the vaccine certificates, vaccine passports, whatever you want to call it, because I'm sitting here in New York and people keep asking me, when is Europe going to be open for business? What's the technicalities? Who can enter? Who can leave?
Well, Maria, I have good news for you because if you're in the U.S. and you've been vaccinated, you could now, in principle, come to Europe and not have to quarantine for your summer vacation. Now, the way that this is going to work is you would have to show that you've been vaccinated, tested negative, or actually gone through coronavirus and then take a normal holiday. Now, Annmarie, the idea here is that this travel certificate, which we believe will go into effect in late June, will help to streamline the process, to make this very easy. From the experience of the past summer, we know that if it's complicated, people are simply not going to travel. This should, in principle, make rules for all countries the same and make it faster and much easier for potential visitors to come into Europe. And again, that optimism too feeding into travel stocks in Europe. If you look at what stocks are doing year to date, they've up 13%. Again, really picking up on that optimism.
All right, our thanks to Maria Tadeo in Lisbon. She'll be tracking that finance ministers meeting all throughout the day. Peter Shafrick, RBC Capital Markets global macro strategist, still with us. Peter, I'm quite taken with the fact that the European Union seems to be the first economy really out front when it comes to these certificates, which many say could speed up the recovery. Do you agree with that assessment? And what sectors do you think will really get a boost from something like that, a vaccine passport?
Yeah, well, look, I mean, Europe has generally been very. Already last year was trying very hard to keep the economy open, particularly as far as travel and tourism is concerned. And when you think about why, I mean, it makes sense because those countries, the most affected by the crisis are the southern European countries. Those countries have a significant tourist sector. And when you try to help these guys, as very clearly the European Union wants, and then this is one of the things that you got to get going first. So I'm not surprised that they're talking about these vaccine passports or these certificates. That makes perfect sense to me. And also when you look at sort of the other support mechanisms that have been put in place that primarily supporting southern European nations. So in my mind, first and foremost, it's a story about which geographic region do you want to help with? And that's very clear the Southern Europeans. And then when you talk about sectors, I mean, it's, in my mind, going forward, it's very clearly those sectors that have been decimated beforehand, such as the travel sector, but also, for instance, the banks, and those sectors that benefit generally from higher yields in the first hand, but also in reopening and trying to boost their earnings. And those sectors, in my mind, should be doing quite well.
When you look at the bond market, you talk about the difference what's going on, the U.S. Treasury yields and the bond market, and how we are seeing this drive higher in yields happening in bonds while U.S. Treasuries are really going sideways. Is there changes in perception of the narrative between what's going on in the United States and Germany?
Well, I wouldn't necessarily say a change in perception. I think it's just a change in speed over here in Europe. Speed in two senses. First of all, in terms of the vaccination process, because essentially the same that happened with the bond market happened with the treasury market already a couple of months ago. So we're playing catch up here, or the market plays catch up here. I mean, now the speed of vaccinations in Europe has exceeded the speed of vaccinations in the US, not the total numbers, but the speed. And the market is recognizing that. And then, you know, all the reopening talks and that follow on from that need to be factored in. So when you look, for instance, at growth expectations, the US, the UK, they already accelerated late last year, early this year, but the expectations for Europe haven't. And I think it's a catch-up story, and that's driving bond markets as well.
We're having a very good conversation. This sounds like all very good news, Peter, but the United Kingdom, the number of cases of the variant from India more than doubled for a second week. What is the risk of a delayed reopening in the UK, which was at forefront, really, of the vaccine program?
Yeah, so if you allow me sort of to not necessarily only focus on the UK, but I'll come back to your direct question. I mean, clearly, these variants are, I mean, they're called variants of concern for a reason. And they're a clear concern. And I think the concern is twofold. First of all, that they're spreading very fast. And therefore, as we haven't finished our vaccination program, and that they then sort of cause a renewed outbreak amongst those who haven't been vaccinated. But then even more concerning is the question about whether it could evade the vaccines in the first place. Now, on the first part, I think that's also where the UK comes in, because we have pockets where the country hasn't been vaccinated as much as a whole, and that's particularly sort of in some of the regions that are currently most affected. But also the good news is that the most recent evidence that comes out seems to suggest that the vaccinations are still viable against even those strains. So that's the good news. Now, back to your questions for the UK, I think there is a reasonable risk that the last step in June can be pushed further out. But I mean, the key thing is we're already at a stage where we have opened quite a lot. And in my mind, it's just a question of time until we get to a stage where most of the things that we all love will be allowed again. It's just a question of time when we get there.
Yeah, the comments coming from the government, really, for me, it's deja vu in December, was signaling that potential that it's going to lock down again, potentially not that liftoff on June 21st. Peter Shafrick, thank you so much for joining us this Friday morning, RBC Capital Markets global macro strategist. Now, just ahead, Israel and Hamas implement an Egyptian brokered ceasefire early this morning, ending 11 days of conflict that has killed hundreds. More on that next. This is Bloomberg. This is Daybreak Europe. I'm Annmarie Horden. Now, Israel and Hamas have agreed to an Egyptian brokered ceasefire ending an 11-day conflict that has left more than 200 dead. U.S. President Joe Biden has praised the truce, which came amid growing international pressure to end a barrage of airstrikes coming from both sides. For more, we are joined by Bloomberg's international executive editor, Ross Matheson. Ross, what are the next steps now that the ceasefire has actually taken effect?
Well, the first thing that needs to happen is to actually bed the ceasefire down further and try and ensure that it sticks. There's great relief we're seeing this morning on both sides, but also we're coming out of 11 days of nightly barrages. And so does each side, for want of a better word, feel that they got what they wanted from this? For Israeli Prime Minister Benjamin Netanyahu, does he feel like he's done enough? Because he really said he wanted to, quote, degrade Hamas's military capacity and its infrastructure and its commanders for good. Does Hamas in turn feel that it better established itself as a leading voice for the Palestinian people in the region against the Palestinian Authority, its key rival? And for the mediators, particularly as you were saying, the Egyptians who've done the hard work on this one, are there systems in place to support the ceasefire? Are there mechanisms in case there's an isolated incident that could risk fighting resuming? Are there communication channels, even if it's through intermediaries? So there's a lot of work to be done just to ensure that this ceasefire, which is in just its very first few hours, does stick, let alone sustains in the longer term.
As they try to make sure and ensure that the ceasefire actually holds, what is the risk right now that fighting breaks out relatively soon?
Well, they have fought 3 inconclusive wars in the past, and we've had this most recent conflict. So that's always a risk that it breaks out again, even if in this moment, of course, their incentives are to de-escalate, because you've got very long-running, complex and painful issues underpinning this. The Israeli versus Palestinian issue is just one part of it. The disputes over territory, over homeland, over rights to housing, these are things you just don't fix with a ceasefire. And you've had intense communal violence in mixed quarters of Jerusalem alongside this. And does that now taper off too? There are issues particular to Benjamin Netanyahu and his hold on power. And for Hamas, you've got its rivalry with the Palestinian Authority. So a whole lot of complicated problems that remain. And as we've seen from history, these tensions tend to dial down for a while, but it doesn't last. And it really doesn't seem for now that countries, including the US, want to take the lead in unpicking some of the broader issues and trying some sort of broader peacekeeping process.
Ross Matheson, thank you so much for that update. Bloomberg's international executive editor, thanks for joining us. Just ahead, open for summer. The EU agrees on travel certificates, offering hope to the region's battered tourism industry. We'll get all the details next. Wow, looks beautiful. This is Bloomberg. Good morning. 6 a.m. in the city of London. I'm Annmarie Horden in New York this week, though. This is Daybreak Europe. Here's what you need to know. Stocks push higher amid falling U.S. jobless claims and a weak tips auction, suggesting confidence in the Fed's view on inflation. European finance ministers meet in Lisbon in person. This as EU negotiators back vaccine certificates in a bid to save the summer. And Israel and Hamas agree to a ceasefire ending a deadly 11-day conflict. President Biden praises the accord brokered by Egypt. Very good morning to you and happy Friday. 90 minutes away from the start of European equities open. For the most part, good news is dominating market direction today. U.S. and European equity futures pointing higher. It's been a very busy week, and the economic recovery, that narrative is the one that is taking hold this morning over the other one, which has been for the most part of the week, inflation fears. And this says yesterday we had fresh data on the U.S. labor market. U.S. jobless claims came in better than expected. So what's shaping up in the markets? When you look across what's going on in Asia, we are seeing the benchmark index move to the upside, up 0.3% higher than we were about 30 minutes ago. A little bit of a mixed picture when you look across indices, though. Japan certainly higher, but we are seeing a little bit of a pullback in Hong Kong and China. NASDAQ futures this morning also about 0.3%. We did have tech make a comeback yesterday, rallying past its 50-day moving average. 10-year Treasury yield sitting at 1.63%. Yesterday, we had the 10-year inflation-protected Treasuries auction, those TIPS auction. Weaker demand, thus, though, that suggests potentially the Fed's narrative is starting to gain a little bit more confidence on what is going on with inflation. And then Bitcoin this morning, 40K flat. But what a week it's been. Since a week ago, we've lost about $8,000 on Bitcoin, and it's, I believe, the second worst week ever for the cryptocurrency since, of course, we had that turmoil last year with the pandemic. Now, moving on, what's going on in Europe? EU finance ministers gathering in Lisbon for the first in-person Eurogroup meeting since September. This, of course, is the bloc's vaccination campaign advances amid optimism about a strong economic recovery is growing. Irish Finance Minister Pascal Donoghue and Portuguese Finance Minister spoke in a joint interview with our very own Maria Tadeo. Take a listen.
I believe the optimism about the prospects for the euro area are justified. If you look at where we are from a vaccine point of view, we now have over 30% of European citizens have received a vaccine. And I believe we will deliver our target of a large majority of citizens receiving and being vaccinated by the summer. So this, combined with really good and sensible economic decisions, mean that we should be optimistic about our prospects for the second half of 2021, leading into a strong start for 2022. And therefore, I do believe it is possible that we will see further revisions in our growth expectations as we move through the year.
So that's bullish also on that note. And Minister João, in the case of Portugal, I know that the central bank is already saying we could see an uptick in growth. We're seeing that this week you're reopening for tourism. It's a key sector for your economy. How optimistic are you about the prospects for the Portuguese economy?
We are becoming very optimistic. We went from a very strict lockdown in the winter, very tough, intense, but now the vaccination program is working very well. The number of cases is extremely low. We're opening up already most of our economy, and the numbers remain very low. And now the tourism is back. So we are actually very optimistic. We expect that the GDP growth is going to be higher than we submit last month, because the numbers now, for example, just a quick number. So if you look at the consumption numbers of last month, they are already higher than pre-pandemic levels. So it's a signal that the recovery is underway. And
would you say, just to rub on this issue, when the market looks at the recovery and they assume that the same dynamics that are driving the U.S. economy and especially the debate around inflation, is it wrong to assume that the same thing will happen in Europe? They're two different recoveries in nature?
The recovery in every part of the world, I believe, is likely to be different because even though we've experienced a common difficulty in the pandemic, it has experienced and affected different economies in different ways. But here in Europe, if I look at where we are, I think it is to be expected. We will see a change in price levels as companies in Europe try to get more raw materials, try to hire staff, try to reopen supply chains. And I believe it is to be expected that you will see a shift in inflation, but I believe it will be temporary. And the reason why I believe that will be the case is if you look at other economic indicators, for example, where we are with unemployment, where we are with underemployment, I expect to see big improvements in those areas across this year and next year.
The Irish and Portuguese finance ministers speaking to Bloomberg's Maria Tadeo in Lisbon in person. Joining us now is Silvia Ordana, head of European economics research at Barclays. Silvia, fantastic research. Europe after COVID-19, make or break, you say. You say scarring effects from COVID-19 will likely hamper the economic recovery and widen the performance gaps between the euro area in these countries. You also talk about this remains, you say, represents a credible threat to the future of the EMU, the Economic and Monetary Union. Let's start with the scarring effects of your research. Where do you think they will be the most acute?
Good morning. In our research, we show that they will be most likely more acute in the southern European countries than in the northern one. And this has to do with the fact that the economic structure of these countries are different. The South relies more on the contact-intensive service sector, so sectors that are in the travel, hospitality, arts industry. And so they have been affected more by the pandemic. And as we move forward, we think that even though fiscal support has been extraordinary and is likely to remain, once governments begin to scale back the fiscal support, some scarring effects will emerge both in the labor market and in the corporate sector.
Something like vaccine passports, Silvia, could those programs help Southern Europe, especially as they are a major destination for tourists?
Certainly. We think that cyclically, this reopening of the economies, tourism season is going to help. And in fact, if you look at the very near term, we have growth rates that are higher in the South than in the Northern European countries. However, when we move forward this second half of the year and we look into next year, we note that the labor market underlying is weaker in the Southern European areas. The underemployment is higher. Labor force participation has dropped more. On the corporate sector, we start seeing bankruptcies increasing in Italy and Spain, but not in other countries. And so we think that the leverage, the liabilities that have been accumulated in this sector throughout the crisis are going to take more time to be able to be reabsorbed. On the positive side, these countries will benefit from the NGU funds that will begin to be disbursed starting from the second half of the year. And investment projects, we think, are going to be put in place in a very effective way. However, these are projects that will take many years to come to fruition.
I want to get a little bit into your thoughts about the potential threat to the Economic and Monetary Union. Didn't the debt crisis really teach Brussels a lesson, and the fact that the Recovery Fund is an indication of that lesson to be learned?
Yes, definitely. This is also our view. And in fact, we don't think that we will see anything like what we have seen in the crisis. What we are saying is exactly going in this direction, that the crisis has teach us something, that the fact that we have countries that have different levels and degrees of output gaps, different fiscal fundamentals that will be more dispersed and diverse after this crisis is really the opportunity for the European Union to go even one step ahead of what they've already done. So we think that the political leaders in Europe understand that potentially the one-size-fits-all policy, monetary policy of the euro area is difficult to run with lots of divergence. And so more fiscal integration needs to come to make this project even more viable in the future.
I mean, if you see capital market integration, what kind of time frame could that be?
Well, obviously, some of these reforms, when we speak about capital market integration, fiscal unions, they take time. And, we know that the process cannot be, can be bumpy, cannot be a linear straight line. But we think it's important to have a concrete roadmap, both from where we are today to a monetary union that is also more integrated on capital markets and on fiscal union. So in the next 12 to 18 months, what we think it's important that the leaders, the political leaders in Europe, in our view, there is a good chance to try to put this roadmap in place with effective deadlines. I like a bit the analogy with the Maastricht Treaty, right? It was signed, and then we had 10 years before we could.
Yeah. It's a very good analogy. It's a very good point. You also say in your notes a deeper economic divergence within the euro area could be a catalyst for momentums towards more EU integration. How? How could more divergence lead us to more integration?
Look, more divergence means two main things. One, Italy, Spain, Germany, and France, and having different levels of output gaps means that they face different inflationary pressures. And so, the common monetary policy is obviously more difficult to put in place. These countries will face different shocks, and when they do, when they are affected, we know that they have different fiscal capacities to react to these shocks. We learned from this crisis that the European Central Bank, to have a viable monetary policy, has to prevent financial fragmentation. And so we think that all these lessons from the previous crisis are very well known. So divergence means having more difficulties to run policies at the euro area level. Divergence and inequality also meant the resurgence of populist Eurosceptic parties after the European debt financial crisis. Now these parties are less in popularity, but it doesn't mean that if we leave some country or some income group behind, their consensus cannot come back. It could. And I think it is, some policy leaders understand and have full belief in the European project. They also know that the majority of European citizens are in favor of this project. And so we think they will interpret these preferences. Others, I say, might do it because of the fear of exit, right? We know that even discussing the potential for a country to leave the euro area would have very, very high costs that could be measured by the degree of financial integration that there is between countries. I like to look at the BIS statistics on cross-border exposures of banks, and if you compute the cross-border expansion of French banks to Italy, it's the analogous of 12% of France GDP. So this gives a good sense of how deep the cost would be if we were just having these threats of leaving the euro area reappearing. So these two forces, I think, will be a catalyst for working more together. And European citizens like that. Surveys show that more than 50% are in favor of the European project.
Sylvia, thank you so much. Her latest research, Europe After COVID-19, you call it make or break, head of economics research at Barclays. Thank you so much for joining us. Shifting gears, what's going on in the United States? They're calling for a global minimum corporate tax of at least 15%, less than the 21% rate it proposed for the overseas earnings of U.S. businesses, a level that some nations had argued was just excessive. Joining us now to discuss this is Bloomberg's Michelle Jamrisco. Michelle, why are they going lower? In the sense that if you're in a negotiation, shouldn't you always start high and then slowly battle your way lower? They're starting low and even saying, but we like it to be a little bit higher.
Yeah, that's right, Annmarie. Good morning. It is an interesting tactic. I mean, there are a lot of numbers floating around. Of course, the 15% global minimum, which, as you mentioned, is a minimum in the negotiations. Treasury Secretary Janet Yellen has stressed that it's a starting point and that she would hope that countries would be on board with higher in the talks. I think it's going to be really difficult to get others on board going forward. It's already higher than the 12.5% that the OECD has been trying to negotiate with some 140 countries for years, and which the Trump administration was highly opposed to. So they're kind of starting on the back foot and trying to move forward up to 15%. But yeah, it looks a little different from the domestic situation that they're proposing. Also not so popular, of course, with Republicans, nor with moderate Democrats. The 21% for U.S. companies' foreign income, the 28% for the domestic corporate tax rate. So a lot of numbers floating around and a big debate ahead. And I would just say the administration's push against corporates and trying to get them to pay a little bit more in revenue has taken on new meaning in the pandemic. So they're kind of making this a political move. Economists are tracking, of course, the widening of inequality, including through the digital divide and all these tech companies that are succeeding succeeding while other sectors and pockets of the labor market continue to suffer. So it has become quite a political debate. And it's not, I will say, it's not unanimous rejection from the corporate world globally. Some firms will welcome a more organized system. It's just going to take a lot to get there, to work out the inconsistencies and the loopholes and to figure out compliance efforts going forward if they do agree on a specific number.
Michelle, given it's been such a volatile week in crypto, very quickly, what's the Biden administration doing around cryptocurrencies that was not welcomed by the community, to say the least?
Yeah. They certainly added a wrinkle to the crypto news this week, of course. They are proposing in this larger tax proposal to get more revenue and obviously get more people filing their taxes. They're proposing a requirement that transactions through cryptocurrency of $10,000 or more be reported to the IRS. This, of course, is the current and longstanding cash transaction guideline. So they're just really trying to bring cryptocurrency more back into light. And those who have followed and filed taxes for 2020 would notice on some individual tax forms that they're mentioning cryptocurrency more. They're also calling for banks and cryptocurrency exchanges to report transactions to the IRS. So all kind of a push to bring this crypto exchange and crypto transactions into daylight.
All right, Bloomberg's Michelle Jamrisco, thank you so much for everything that's going on down in D.C. Just ahead, gone are the days when IBM and ExxonMobil topped lists of the world's biggest companies. In the last 30 years, we've seen the rise of so-called mega firms, according to our data. So what exactly makes one? The Bloomberg Big Take, that's coming up next. This is Bloomberg. This is Daybreak Europe. I'm Annmarie in New York this week. Now, the world's biggest businesses were doing fine until COVID-19 arrived. Now, they're doing even better. The top 50 companies by value added $4.5 trillion of stock market capitalization in 2020. Times have changed, of course. Gone are the big days when IBM and Exxon topped the list of the world's biggest companies. Now tech titans like Apple and Amazon are on the top. Joining us to break down this Bloomberg Big Take report is Bloomberg Economics' Justin Jimenez. Justin, thank you so much for joining us. Your research looks into the world's biggest firms and the way various ways that they've come to dominate the global economy. Just how big have they gotten?
That's right. We dove into the financial data for the 50 largest listed companies by market cap over the past 3 decades. And one of the most apparent ways that they've gotten bigger has been in their growing market valuation. So the market value of the biggest 50 listed firms as of the end of 1990 totaled about $1 trillion. That was equal to about 5% of world GDP at the time. If you fast forward 30 years, and as of the end of 2020, that figure ballooned to about $23 trillion, which is equal to about 28% of global GDP. So in part, that reflects rising asset prices, but we think it also reflects investors' expectations of future profitability, meaning that they expect the biggest companies have the potential to get even bigger.
Yeah, and as firms become bigger, they command more market power. Have you seen that show up in the data?
Yeah, we have. That increase in size, you're right, gives them the ability to stifle competition, to milk their customers, and to squeeze their workers. It also gives them the ability to shape regulation. So what we've seen over the past 30 years is that these mega firms have seen increasingly higher profit margins and increasingly lower tax burdens. So in 1990, the median profit margin we saw for the top 50 firms was at just 7%. By 2020, it had doubled to more than 18%. Over that same period, their tax rate fell by about half, from 35% in 1990 to about 17% in 2020.
Justin, thank you so much for joining us. Bloomberg's Economics, Justin Jimenez with today's Big Take. You don't want to miss that read. You can find it on Bloomberg.com. Just ahead, Bitcoin's wild week. After the manic trading, the choppy markets continue. We talk cryptos next. This is Bloomberg. Good morning, 6:54 in the city of London. I'm Annmarie Horden. This is Daybreak Europe. It's been a volatile week for Bitcoin, to say the least. That would be an understatement. Joining us now is Danny Berger. Danny, are there any signs that more stability is going to come from cryptos now?
And I think we're just really still a long way off to be able to associate stability with Bitcoin. I mean, for one, this regulation concern is still very, very present, whether it be from China or whether it even be from the U.S. Hearing from the Treasury yesterday that they're proposing that anyone who's transferring $10,000 of Bitcoin or more has to report it to the IRS. And look, the Bitcoin proponents would say this is a good thing. This means it's getting treated more like cash, which is what Bitcoin is supposed to be like. But for others, this means that there could be more regulation to come. And we've just seen mass liquidations this week. It's not even the end of the month. So that short-term volatility, I think, is sticking around.
Yeah, I saw a few meme accounts say, we'll just transfer $9,999 if that's what the Treasury wants to do. What does this latest episode mean for Bitcoin in terms of wider spread adoption? Because I thought it was a pretty big deal. The PBOC took to WeChat to say, reminder, this is not going to be used when you want to buy consumer goods.
Yeah, certainly for any institutional players who haven't already gotten in that are concerned about its volatile profile or perhaps how it's treated by governments, this episode is definitely not going to make them feel any better. SocGen, for example, just had a note out saying, look, if you're trying to compare gold to Bitcoin, you can't do it. The volatility gap is just too big. Bitcoin still doesn't have a place in a traditional portfolio as a piece of protection. But for the Bitcoin bulls, like Jim Bianco, he has a new Bloomberg opinion piece out of Bianco Research saying that, look, this is a proof that this decentralized system of currencies works because the decentralized exchanges held up during these periods of Bitcoin volatility. So it is a win for the new forms of finance.
Interesting. Danny Berger will be all across this today. And it is her birthday. So we just want to say from Team Daybreak Europe, happy birthday.
Thanks,
Danny
Annmarie.
should be tracking Bitcoin on her birthday. Lucky girl. Just ahead, that does it for us nearly for Daybreak Europe. Just ahead is the European market open. U.S. and European equity futures are looking brighter this morning. We are in the green. It looks like the market is looking to lean into the narrative of economic recovery, less so on that angst about inflation. Given what we had out of the U.S. yesterday, U.S. jobless claims came better than expected. NASDAQ futures were rallying this morning after NASDAQ yesterday blew past the 50-day moving average. So some optimism at the end of a volatile, busy week. Bitcoin, though, now just below 40K. This is Bloomberg.